Hi, this is Alan Gassman, and this is the presentation called What We Haven't Said Yet about the CARES Act and More. Many of you have joined us for our presentations Monday and Tuesday, and you can send us an email if you want a link to share those with anyone or to watch them over and over and over again as many times as you like. I'm here with Brandon, Ketron, and John Beck. They've done all the work. I'm receiving all the credit. We just scheduled a new one. Tomorrow, if I can get the page to turn, we're going to talk about the laws, the loans and laws for physicians and medical practices. We're going to make this so that it's understandable by most physicians. As you know, many physicians are working really hard in intensive care and emergency rooms or without things to do because they can't do elective procedures and they don't want to infect themselves and their staff. So a lot of pressure on medical practices, and Medicare just released regulations to release doctors from having to comply with self-referral laws with reference to prescribing and treating the virus. So we'll be talking about that tomorrow. I hope to have Lester Perling on with us or to get his guidance before then. Now, Brandon has been working on this chart because I don't know about all the attendees, but I've been confused on when the economic emergency disaster loan applies and when the Paycheck Protection Program applies. So we're going to go through this chart with Brandon. You can use this chart with your clients. The first column, or the first row rather, is who is eligible. Well, it's small businesses, and there's no definition yet of what a small business is. So just like with Section 199A, if you're a landlord with nothing but triple net leases, we don't really know if you're going to qualify as a small business or not. I hope you will, and that this will be applied more liberally than under Section 199A, but it may not be. But under the EIDL, the entity or the business person who is the entity must have suffered substantial economic injury. So this isn't everybody. It's entities that have suffered substantial economic injury with less than 500 employees, and this gets you that quick $10,000. On the other hand, your Paycheck Protection Program applies for entities where there is uncertainty of the current economic condition, which makes the loan necessary to support the ongoing operations of the business. So you could borrow under PPP even if you have not yet suffered substantial economic injury, because you may need this money, the way I read it. Now, the economic injury disaster loan, you can get right on the internet. You see the website, you see what to click on here. That takes you there. The PPP, as I understand it, is going to be through banks. You can look at the draft application and start filling it out, but it is not yet active, and we believe there will be more information forthcoming. With the economic injury disaster loan, the maximum loan is $2 million. With the PPP loan, the maximum loan for 99% of people is going to be 2.5 times the average monthly payroll cost for the past year. And Brandon, is that the past calendar year or the past 12 months?
Yeah, it's the past 12 months, so it starts January 31st going back. So it's not exactly your 2019 year, it's January 31st, 2020, back 12 months.
Now, your deadline for applying is December 31st for the EIDL and June 30 for the PPP, so there's plenty of time. Obviously, you want to apply sooner rather than later to get your claim paid. The permitted use of funds, these are different. With the economic injury disaster loan, you have to use your $10,000 or more that you may get later on sick leave for employees unable to work because of the direct effect of the virus, meaning payroll during business disruption, that's going to be for most clients, meeting increased costs to obtain unavailable materials, rent or mortgage obligations, and repaying obligations other than those above that can't be met due to the circumstances caused by the virus. So those are what you have to use the money on. A client just emailed me that he just got his $10,000 loan application done. His business has not been substantially suffering. He doesn't have any of these 5 things to pay. So when he gets his $10,000, I think he's going to have to send it back. Now for the PPP program, this will cover all your payroll costs and mortgage interest deduction, interest on other debt, rent, and utilities. So you have different payments that you can make with each of these. So Brandon, do you want to cover now on the second page what the loan forgiveness situation is?
Yeah, so for the economic injury disaster loans, that $10,000 that you get in as an advancement is really considered as a grant. So it's not required to be repaid, even if you're subsequently denied for the full economic injury disaster loan. Now, there is the catch that you have to use it for those permitted uses. If you don't use it for those permitted uses on the previous slide, then you'll have to repay it to the extent that you used it to pay for something else. And then any amounts over that $10,000 grant that you receive, that's going to have to be required to be repaid under this economic injury disaster loan. Now, for the Paycheck Protection Program, after you get the loan, you have an 8-week period that you measure costs that you've used for payroll cost, mortgage interest, rent, and utility payments. And to the extent that you use the funds for those specific items, the loan's fully forgivable. If you use them for other things outside of that, you may have to pay back a portion. Now, if you get an EIDL loan, since that application is available now, you subsequently get approved for a PPP loan, you can actually roll over the EIDL loan into that PPP loan and qualify for the forgiveness if you use it to use for payroll costs, mortgage interest, rent, and utility payments. Now,
so it sounds like it's a no-brainer to get the EIDL loan as soon as you can.
Right.
To see where you can get the money first, because you can always roll one into the other.
Correct. Now, as far as the forgiveness amount go, that's the basic measurement is that 8-week period, but you can have that reduced. So you may not get the full amount forgiven if you don't use it for those expenses, or if you receive a grant under the EIDL loan, that $10,000, that's going to reduce the amount that can be forgiven under the Paycheck Protection Program. If you fire an employee, you're going to have a percentage reduced from the amount that can be forgiven. So let's say you have 20 employees the last year, and you only have 19 employees during that 8-week covered period because you've let one go or had to lay someone off. 5% of your loan that would have otherwise been forgiven is going to have to be required to be repaid. Same thing applies if you reduce someone's compensation by more than 25%. That reduction is going to cause a portion of the forgiveness to be reduced. Now, there's an exception where if you correct that reduction or rehire someone prior to June 30th, you can go back to have the full amount forgiven. Now, on the other side, for the economic injury disaster loan, you don't have to worry about repaying the $10,000 unless you use it for something that's not permitted.
Or I think a better way to say it is you need to spend at least $10,000 on those items shown on the previous page. It's not a tracing of the exact money, but if you spend less than $10,000 on those items, then you have to give the difference back. So Brandon, as you know, my wife works for the office, and she's terribly underpaid because we didn't want to pay payroll taxes for her. But she's worth a lot more than we're paying her. Can we increase her compensation now to fair market value? And can we borrow money and have it forgiven as she does work for the firm? Or does this have to be based on historical?
Yeah, so you can do that. There's nothing that prevents you from adding a spouse or adding someone or increasing someone's salary during this covered period. I think where you're going to run into an issue is that maximum loan is 2.5 times your monthly payroll costs based on the prior year. So if everything else stays flat and you increase someone's compensation, that's not going to be covered under the loan because you're maxed out based upon the prior year. So you can increase it, but you may not be getting enough funds to cover it.
Okay, now if she takes the job of another employee who has been receiving a full paycheck, is that treated any differently? Or again, it's just a matter of whether you come under the 2.5 ratio?
Yeah, that's not treated any differently. So if she replaced someone that was fired, that might prevent you from having your loan reduced or the amount that can be forgiven reduced. So that might be an idea, to add a spouse or to increase someone's salary to make up for the fact that someone's salary has been reduced.
And by increasing Marcia's compensation, I can also increase what she's going to receive from Social Security upon retirement. So that could have a dual benefit. I could also increase what we put in the pension plan for her. So that would be a triple benefit, something that everyone should think about. Brandon, what about independent contractors? Even our law office pays certain people a fixed amount to provide us with certain services. Are those treated the same as payroll or different in any way?
Yeah, so the statute actually says, and we have some slides on this later on down that provide some more detail here, and we'll be adding to this chart as we learn more. But independent contractors, the statute actually says payments of any compensation to or income of a sole proprietor or an independent contractor is considered as a payroll cost. So if you're an employer and you're making a payment to an independent contractor, that's a payroll cost. If you're an independent contractor yourself and you have income of the independent contractor, that's considered as a payroll cost. So essentially what this loan program can do for independent contractors, if they're not receiving income, it can replace that income that they would have otherwise received through the Paycheck Protection Program. So the 1099 compensation that independent contractors get can be included as payroll cost and paid out of these loan proceeds to the independent contractor.
Okay, so from what I see here, it's a no-brainer for any business in any entity, in any industry, to make the application for these loans, receive the loan money, and decide what to do with it, whether you repay it or whether you keep it and spend it on what you're allowed to spend it on, correct?
That's right.
Okay. And the definition of business we'll hopefully have soon. For example, we have a private foundation that administers piano lessons for students. And we've had a major disruption. We can't get the piano lessons for the students because they can't physically show up. So we could provide the students with laptops, which they could also use for their schooling. They're underprivileged children. They don't have laptops at home. But is that a business? We just don't know yet.
Right.
Anything else come to mind on this chart and what we'll be adding to it?
Yeah, I just think, just to talk a little bit about the differences between the two, there's difference in the amount, the length of the term. The economic injury disaster loan can be 30 years, whereas the Paycheck program is only 10 years. If you receive over $25,000 under the EIDL loan, you're required to pledge the assets of your business as collateral, whereas under the Paycheck Protection Program, there is no collateral, there is no personal guarantee. Also for the EIDL loan, if you have over $200,000, you're required to personally guarantee that. But there is a caveat that you're not required to pledge any assets, any real estate assets. So you don't have to pledge your house or any other property that you might own. It would only be business assets or other assets available.
Okay, so for a lot of people on this call, the most important thing we're going to say is that if you are putting money into your company to make ends meet, or the company owes you money, we strongly recommend that you get a promissory note and a security agreement or mortgage giving you a first lien or a second lien as applicable on the assets. And that may enable you to get paid before the government gets paid under the EIDL. We don't know all the details yet, but we see here that if you're going to borrow more than $25,000 under EIDL, you're going to have to give a lien. But maybe if you already have a lien, the government's lien will be second and you will be first. But for reasons completely unrelated to these loans, i.e. the possible insolvency of your business if this virus drags out for months and months or even a year versus weeks, you're going to want to be able to stay ahead of the non-related creditors by giving yourself a lien. You're not going to want to be taking dividends out of your company. You're not going to want to be taking anything out exceeding your reasonable compensation. But if you've been taking $270,000 a year out, you can continue to take that out. Now, another question that we've been getting is, should I terminate my employees and let them go on unemployment? Should I terminate myself, and should I go on unemployment? And I think the rule of thumb is that if you can terminate your employees, get confirmation from your insurance carrier that they'll continue to honor the health insurance for those employees during this time of furlough, the employee can get unemployment. The unemployment would be the normal unemployment plus an additional $600 a week. If the employee comes out ahead with that, it seems like a no-brainer to furlough them or reduce their hours to what you need. It may only be 3 or 4 hours a week. Unemployment, we think, will cover the rest, and the employee will be better off. The government won't have to give you money to pay your employees. On the other hand, if you are a doctor making $180,000 a year, you could reduce your salary to $100,000 a year. And the PPP program is going to cover that. They're going to give you the money. They're probably going to forgive it. And then you don't have to go on unemployment, because $600 a week plus unemployment is going to be a lot less than what the PPP is giving you. Does that sound correct, Brandon?
Yeah, the only thing I would add, though, if you're trying to mix the two, where you're getting a Paycheck Protection Program loan to pay your salary up to $100,000, and then you lay off employees, you have to watch out, because again, if you reduce the number of employees you have, the amount that is forgiven is also reduced. So you don't want to, pigeonhole yourself by eliminating employees and not have the full forgiveness available.
Right. And for those of you listening, if you have any questions on these loans, please do email Brandon, especially, so that we can continue to learn what we don't know as we are assisting clients in applying for these EIDL loans, at least to get them that first $10,000, and to properly situate things from a creditor protection standpoint, unemployment compensation standpoint, health insurance standpoint, and otherwise. And if you are a medical practice or you represent medical practices, tomorrow we're going to concentrate on the medical practice rules. And before I forget, one that was just sent to me by Lester Perling, hot off the presses, that Medicare has rolled back the enforcement of certain anti-kickback and self-referral rules when it comes to treating patients affected by this virus. So that's going to be a good opportunity for medical practices, and it's going to be good for the present environment. And Lester's going to explain that tomorrow to us. Brandon, are there any more slides you want to cover with respect to these loan programs before we go to slide 34, which is the next topic?
Yeah, I think to just point out, let's see if I can get the slides moving here, just really how simple the application is for this economic injury disaster loan, the EIDL loans. Here's the application here, and it's not complicated at all. It's really just filling in business information. The only information that I think you would really need to maybe look up and request from somebody is your gross revenues for the 12 months prior to the disaster, which is January 31st. And then your cost of goods sold, if you have inventory or other assets that actually deemed cost of goods sold. That's really the only two things that you might have to request information from someone for. Otherwise, you should have most of this information yourself. It's a fairly simple application here. I'm just scrolling through it. And then here, the most importantly, would you like to be considered for an advance of up to $10,000? Make sure you check that box. You put in your banking information, and you should receive those funds within 3 days.
So Brandon, here's a question. Let's say a medical practice has a limited liability company that operates the practice. That limited liability company gives a portion of the profits and positive cash flow to separate S corporations owned by each separate doctor. So is that one loan for the medical practice with $10,000 and then a separate one for each separate doctor, or are they aggregated? We don't really know that yet, do we?
Yeah, we don't really know that. The statute does say you're limited to one loan per EIN. So each of those entities would have its own EIN. So, they're eligible in that regard. But then I think the question becomes, which one is the business? And I think that's probably going to be the limitation, that it's going to be per business, so that only the medical practice could get it. But we'll see if we get more information on whether or not each of those individual S corporations might also be eligible.
Okay, very good. So do you want to go to slide 34 now?
Yeah, and here's just the sample application for the Paycheck Protection Program. It's also, the sample seems very reasonable, very simple compared to, the EIDL as well. So I think, these should be fairly easy for people to fill out and get submitted.
Okay, so Monday night, Lineberg released my article on creditor protection under the virus. And as I've said before, but I'll just say it again, I'll say it more succinctly than I said it yesterday. We don't know what the economy is going to be, or to what extent there will be an economy when this lifts. In the 2008 recession, vacant real estate went to 23% of its value on average in Florida in a matter of weeks. Residential and commercial real estate went down between 25 and 35% in a matter of weeks. If you have a situation where you now have enough equity because of loans, but you may not have enough equity because of what may happen, then you need to talk to a good debtor-creditor lawyer and other advisors and make sure that you are ahead of the other creditors to the extent that that's possible, that you are properly administering any company or entity with due regard to your fiduciary duty to creditors, which is a part of state and federal law, and that your entity is going to be well suited and able, if it needs to be insolvent or to file a Chapter 11 bankruptcy, because things may come to that. Murphy's Law, if anything can go wrong, it will go wrong at the worst possible time. You have to be prepared for that. Things may get worse here. I hope things won't get worse because the government's paying $2.2 trillion to pay everybody's payroll and everyone's utilities and everyone's rent and everyone's interest expense if you're a business, but we just can't be sure what's going to happen. So if you have money owed to you by your own company or you're putting money in, get a loan agreement, get a security agreement, and if you have the temptation to hide money or put false information on credit reports or financial statements by putting a little bit aside, no one will know but you and your advisor. Don't tell me I don't want to go to jail with you, and don't do that stuff. Don't think that that's going to work. Get with your CPA as soon as you can. If your CPA is not available, see who your CPA recommends to help you with your cash flow planning. Be very realistic, understanding this virus may keep us at home for 3 months, 4 months, 5 months. So what you spend this week, next week, and the following week may prevent you from being able to preserve your business if this thing goes on for 5 or 6 months. Also, we're going to mention in a little while, but I don't want to forget, if you have an LLC or other entity or personally owned investment real estate that has a significant mortgage on it, you may want to convert that to being inside of an S corporation sooner rather than later, and before the amount of debt exceeds the basis of the real estate, so you don't trigger tax doing it, and you have much lesser chance of having income tax when you later negotiate with the banks. These are things that CPAs and lawyers should be reaching out to clients to discuss. It's going to make a big difference. And of course, if you have assets that are exposed to creditors and assets that are safe, spend the assets that are exposed to creditors. Don't borrow on your home equity line. Borrow on your boat or sell your boat. Borrow on your vacation home or sell your vacation home. Don't pull money out of your 401k. The new law says that employers can allow employees to borrow up to $100,000 from their 401k. Do that. Or if you're going to do that, you should intend to pay it back. These are creditor protected assets. They're income tax advantaged assets. These things need to be considered very carefully. When your employees come and borrow money on the 401k, I hope that you politely read them the Riot Act with respect to this. Now, John, on the charitable deduction side, I don't think there's a whole lot to know this week, other than anyone who does not itemize deductions can give $300 to any bona fide charity, other than a donor-advised fund and a supporting foundation, $300 tax deduction, and know that they did something nice. But my wife donated $300 this week to a charity, which I think is really nice, but we itemized, so we're not going to get the deduction. It's not a big deal. It's just something that people need to understand. Someone was kind enough to put together a chart which explains that if you give cash this year, you can donate up to 100% of your adjusted gross income and get a tax deduction for that, but it has to be cash. It cannot be appreciated assets. Like that 60% of adjusted gross income rule that came into effect under the Tax Reform Act, it has to be cash, and you can't give 30% or 50% in appreciated assets, and then the other 50% or 70% in cash. You have to give all cash, get up to 100% AGI. Now, John, I know that you could also, if you have a net operating loss, you can carry that back 5 years now and get a big tax refund from Uncle Sam. So if I had a $300,000 salary and a $1 million loss from my S corporation that flows through to me, that gives me a $700,000 net operating loss to carry back 5 years. But could I also give $300,000 to an operating foundation and then have $1 million to carry back for 5 years?
It doesn't appear that would work. The charitable deduction could bring you down to zero income, but it's not going to affect the net operating loss.
Okay. And Monday, we talked about the charitable deductions, and we talked at length on the net operating loss rules, so you can check that video or ask us for more information if you need any more information on that. And then we are big fans of private operating foundations. A private operating foundation is a foundation that actually does something. It doesn't just dole money out. It has an active activity. You may have clients now who have private foundations which can only qualify for a 20 or 30% of adjusted gross income deductions. But those children, those grandchildren are sitting at home, they're watching TV, they're playing computer games, and they could be helping people in the community. You could convert your private foundation into a private operating foundation this week, get active, and then be able to donate appreciated real estate. Do it now before it goes down in value after the virus freeze, in case it does, and get your family active helping others. If you want information on operating foundations, we have articles that we've published, and we'll be glad to cover those. So, John, Larry Hinkle, who was on our call yesterday, had a correction to what we had to say about income from the discharge of indebtedness when you have real estate subject to a mortgage where the fair market value of the real estate is less than the basis and less than the mortgage. The lender takes the property, and you would normally think that you only have income if the property taken had a basis of less than the mortgage. But how exactly does that work, and do you have an example for us so that Larry will let me out of the doghouse?
A couple of examples. So when you, on this slide right here, it depends on whether the loan is recourse or non-recourse. So if you have a recourse loan and you're transferring the property to the lender in part in satisfaction of the loan, you actually have a bifurcated calculation of income. So the outstanding loan balance, if it's over the fair market value, the difference between that loan balance and fair market value will be cancellation of indebtedness income and taxed at ordinary income tax rates, whereas the difference between the fair market value and your basis, assuming your basis is lower than fair market value, will be calculated basically most likely capital gains, but you could have some depreciation recapture. On the other hand, if you're not transferring the property to the lender in satisfaction of the loan, then any reduction in the loan value will be ordinary income. Now, if you have a non-recourse loan, you just calculate the gain according to Section 1001, and again, you'll mainly have capital gain, and you could have some depreciation recapture.
Well, what we said, which is so important for so many clients, is that if you have that client in an LLC taxed as a partnership or disregarded, and there's a chance that a lender is going to come along and reduce the debt, your client will pay a lot less in income taxes when the debt is reduced or forced down if they are in an S corporation or a C corporation. An LLC can be converted to an S corporation, but only if its operating agreement and other documentation is consistent with the second class of stock rules on the effective date of the S election. So even though you can backdate an S election by 75 days, in other words, you can make an S election effective 75 days ago, that's only if 75 days ago the operating agreement of the entity allowed that. So a lot of clients should be amending their operating agreement right now. Don't do this at home. You need to have a qualified lawyer do it. There can be no capital account language. There can be no preferential income language. There can be no options to buy interest for less than book value. You can't violate any of the second class of stock rules. And then you want to make that S election effective at a time when there is little or no excess of loans owed over fair market value. So you may need to adjust the indebtedness so that the indebtedness is owed partly by the shareholders or owners or members and only partly by the entity, so that you can make that election without triggering tax and then let that entity shield the investors from the income from the discharge of indebtedness. So I hope that that is somewhat clear, and we've gone ahead and given you our slides again so that the people who sell you toner can make a lot of money when they come and check your toner use. Now, finally, I'm going to talk a little bit about the employment law. I don't have Colleen Flynn here, so I'm a little bit afraid. It's like standing on the high dive just before you jump. But what we want you to know is that most clients, they're under 50 employees, and they don't have the Family Medical Leave Act, which basically mostly applies to maternity leave. So they're not used to following maternity leave and family leave type of situations. Clients with more than 50 employees are used to this. In addition, if you have 15 or more employees, you have the Americans with Disabilities Act. You have to make reasonable accommodations for people who have disabilities. So now we have a new law which does two things. Number one, it gives you money to pay for certain benefits for your employees if they qualify for up to 80 hours in the first category under the Emergency Paid Sick Leave Act, and then for up to 10 weeks under the second part of the act. So one thing we're going to talk about tomorrow is that a special regulation just came out about 2 or 3 days ago, which says that a medical office is able to tell any of its employees or substantial contractors that they will not qualify under this act. And the reason is because Congress wants medical offices to stay open and to have employees encouraged to show up at work. But what these laws do is twofold. Number one, they tell you when you can get money from the government to pay the employees for these situations. And number two, they make your office into an ADA Family Leave Act type of office, even if you only have 1 or 2 employees, because the employees have the right to stay at home and not work under these circumstances and to get paid. So for the 80 hours of assistance, this would be the first 80 hours that the employee receives. It does not apply to independent contractors, only employees, but they don't have to use their old sick time, their old vacation time. If they are subject to number one, a quarantine or isolation order, which I don't think we have in Florida, or number two, a healthcare provider has told them to quarantine because they have immune system or other issues, or three, they have symptoms and are seeking a medical diagnosis. In other words, they can't be at the office today, they're going to the doctor. Then you have to pay them for their time away up to 80 hours. You're going to get reimbursed from the government for this, but you don't have to pay them more than $511 a day or $5,110 in the aggregate. On the other hand, if they have one of these three issues, number one, they're caring for somebody who has the quarantine or isolation order, or number two, they're caring for a child of theirs if the school or place of where the child goes is closed, or three, they're experiencing substantially similar conditions to those specified by the secretary. We don't know what that is yet. Then you have to pay them for up to 80 hours for these items, but only at 2/3 their regular salary, no more than $200 a day. That's the 80-hour rule. It's not that complicated. Colleen and I are going to do a 90-minute webinar on this for Limeberg, and she's going to go through all the details of it. She does a fantastic job. Now, beyond the 80 hours, if the employee has a minor child or children and needs to stay home with them because there's no other child care reasonably available, then they stay home for up to 10 weeks. Yes, this is going to hurt. The first 2 weeks, they don't get paid or they use their 80 hours up here. The next 10 weeks, the next 2 weeks, they have to pay out of their own PTO. The next 10 weeks, you pay and get reimbursed up to 2/3 of their regular pay rate, not more than $200 a day or $10,000 in the aggregate. Yes, you're going to have employees who say, no, I'm going to stay home with my spouse and my children, and we're going to play Scrabble, and my children really need me. They're 17 years old. I'm going to keep reminding them to take a shower and to close the refrigerator, and I'm not coming to work, ha, 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 because you can't make me. That's where the employee, if they work in a medical practice or a contractor who assists medical practices like a janitorial service or a medical supply company, then they can be told that this law does not apply to them. Again, don't try to do this at home. There's a lot of nuances. Colleen's 90-minute talk is very good. Another thing to think about is, what are the medical insurance implications of sending this person home or reducing their hours? What are the labor law implications of telling a manager, hey, you're no longer a manager, you're now hourly, you can only work 5 hours a week, I've arranged with the medical insurance carrier that they're going to cover your medical insurance. Also, by the way, these rules don't apply once an office is completely shut down. If the employee has an issue of 1 through 6 and is willing to work at home, and you have work that they can do at home and they're physically able to do it, then you can require them to work at home. But if they simply don't want to come to the office because they are afraid that they'll get the infection, and you are complying with the CDC guidelines, 6-foot distancing, everybody's washing everything constantly, and they don't want to come in, they don't have any of these issues, then you can terminate them. Don't terminate them because of their age or because of their religion or because of their national origin or because of their gender or because of who they voted for or because of anything else. But you can terminate them because you don't need them anymore because they're not doing anything for you. And if you continue to pay them, then you're going to have other people in the office who also don't want to come in. You'll have a lot of jealousy. So those are the things that Colleen and I are going to discuss extensively in that Limeberg webinar. Colleen and I also did a free 60-minute webinar that is on the Limeberg website. It does not go into quite as many specifics as to the labor law or the new regulations, but it's still, if you're a generalist, it is certainly worth watching. You should know that for medical practices, the Medicare rules and also the rules by most, if not all, insurance carriers will now pay doctors to do video calls just like the patient was there. So don't hesitate to get your video call with your doctor if you have any issues on your health, or to encourage your doctor to do video calls. It's certainly better than no visit at all, and it does not, of course, expose the employees of the doctor's office to any situation. Okay, we're going to end now with John telling us just a little bit about force majeure clauses, how they apply under contracts, and also the doctrine of impossibility and the doctrine of impracticability, even if you don't have a force majeure clause. Because we've gone way over the 30 minutes, if you're interested in this but you don't have time to watch, that's okay. Just let us know and we will send you the transcript of this presentation from now until the end. Brandon and I are going to go back to work, and John's going to be your master of ceremonies for the rest of this presentation. Please do email us. It's alan@gassmanpa.com, brandon@gassmanpa.com, John at Gassman, GASSMANPA.com. With any questions, comments, or suggestions, we will get them answered. We will help you if we can and as we can in any way. Again, we welcome any questions, comments, and suggestions. Please protect your health first, the health of your family second, the health of your team, employees, and customers third, and do the right thing. It always comes back in the best way. John, all yours. Thank you.
Okay, thanks. Okay, so with the economic downturn from the coronavirus, there will be many individuals who and businesses that can't perform as expected under their contract. So there are some strategies that could be used to try to mitigate the damages and to avoid defaulting under a contract. The first one is force majeure. This is a defense for non-performance, and the force majeure clause is usually in the contract. We all see them. They're usually acts of God and disease, similar types of events that are beyond the control of the parties involved with the contract. And as you see on this slide, slide 84, these are typically acts of God, diseases, emergencies, earthquakes, hurricanes. When these types of events happen, the court typically looks at the contract itself to determine how to interpret the remedies available for the parties. And it's important to determine which state law you want to apply in regard to this, because some states differ on whether something is foreseeable and whether something foreseeable would have to be included specifically in the contract in order to be a covered event. So of course, with the coronavirus, this could be determined to be an act of God and could frustrate many of the purposes that contracts are entered into. And including a term such as a pandemic or illness would likely qualify in most states, if not all of them. And of course, there are some risks by trying to assert force majeure in a contract. Of course, the defense could always fail, and then you could be required to meet all of your standard requirements under the contract. But if you are in that situation, force majeure is probably one of the best defenses available to try to avoid further liability under the contract. And then you also have the doctrine of impossibility. This is, I'd say, one step below the force majeure argument. And here, the performance has to actually be impossible. So it can't just be more difficult or unreasonably difficult. It actually has to be impossible. And it's easy to foresee how this could arise with the coronavirus, where you have mandated quarantines, stay-at-home orders, where individuals can't leave their houses. This could definitely be an argument. This is traditionally applied, for example, when people die or a change in the law makes performance illegal, then you could easily argue that performance is then impossible. The other argument, one step below this, is frustration of purpose. And this happens when parties can still perform their duties under the contract, but it doesn't really make sense to perform those duties due to outside circumstances. So, for example, if you were going to put together a concert, it might be possible to put a concert together, but even if you do, no one's allowed to attend, or a small group is allowed to attend. It's not really serving the purpose that it was put together for. And most jurisdictions follow these same elements, that the frustration of the principal purpose must relate to the principal purpose of the contract. The frustration must be substantial, and the non-occurrence of that event was a basic assumption of the parties when they entered into the contract. Of course, most parties didn't expect the coronavirus to become this big of a problem, and it's not really a foreseeable issue. And then you have impracticability. This is less of a good argument to try to avoid being held liable to fulfill your requirements under a contract, because you could still perform the acts. It's just going to be much harder. So here, for example, if you can still build a home, it just becomes more difficult because you have less employees on the work site. Some may be at home sick, and it's going to cost you additional money to hire extra contractors. If you didn't have other provisions in your contract already, you could say it's impractical, but this isn't as strong of an argument as, say, force majeure or frustration of purpose or impossibility. So this is definitely not something that you'd want to rely on, but it is there as an argument if that type of a situation ever arises. And the case that summarizes this pretty well is the Florida Laundry Services, Inc. versus Sage Condo Association, Inc. case. Here, there was a company that was engaged to provide laundry services and make washers and dryers available for another company, but the washers and dryers had to be disconnected because there was a violation of code. And since there was a violation of the code that prevented the contractor from fulfilling its duties, the court ruled that the contractor was allowed to not fulfill all of its performance under the contract and was absolved of its continuing obligation. And of course, this is definitely something that could be used in relation to the coronavirus, because as everything shuts down, it's going to be much more difficult to get business done. Many businesses, their business will slow. They won't have access to the tools and resources that they need to finish work under many of their contracts. So this is something to consider, but of course, this needs to be carefully considered before a defense like this is used. And that concludes our presentation. Please feel free to email myself, Alan, or Brandon, and I hope you all have a nice day. Thanks.